Hey trader, welcome back to ComLucro. Today, we're diving into one of the most effective ways to combine structure and precision in your trading, using market structure analysis together with Fibonacci tools. This strategy helps you spot high probability setups, trade in sync with momentum, and simplify your entire decision-making process. By focusing on core concepts like change of character, break of structure, and Fibonacci retracement and extension, you'll learn how to read price action with clarity and confidence. Whether you're refining your strategy or just getting started, this lesson will help you trade with discipline, consistency, and a professional mindset. So if you like this kind of video, please like, subscribe, and turn on notifications. And join the ComLucro community to support the channel and keep improving as a trader. Let's start with the Fibonacci retracement. Open your chart on TradingView and select the retracement tool. For bullish moves, connect the low to the high, ensuring that 100% is at the starting point and 0% is at the end. For bearish moves, reverse the process, placing 100% at the top and 0% at the bottom. Once the retracement is drawn, open the settings to customize the tool for a cleaner and more effective analysis. First, extend the lines to the right so they remain visible as the chart develops. Then uncheck all unnecessary levels, leaving only the essential ones: 38.2%, 50%, and 61.8%. These are your key retracement zones. Turn off the background shading to declutter the chart and disable the display of price values to maintain focus. Lastly, make sure the levels are displayed as percentages by selecting % under the level section. This setup simplifies your chart, emphasizing the most critical areas for retracement analysis. Next, let's dive into setting up your Fibonacci extension tool for precise and effective analysis in TradingView. To set them up, select the Fibonacci extension tool and mark the 3 points: the start of the move, the end of the move, and the end of the retracement level. For bullish trends, go from the low to the high, and for bearish trends, reverse the process. Once drawn, open the settings and adjust them for clarity. First, extend the lines to the right, making them easier to track as the price evolves. Next, remove unnecessary levels and focus only on the key ones: 100%, 161.8%, 200%, and 261.8%. Disable the background shading to keep your chart clean and visually focused. Also, turn off the display of price values to minimize distractions. Lastly, under the level section, switch to % to display the extension levels as percentages. Let's now analyze the market structure, which is currently in a downtrend, and wait for a change of character to signal a potential shift before considering buy opportunities. As you can see, I'm marking the lower highs, LH, and lower lows, LL, on the chart, along with the descending trend line to highlight the bearish momentum. I'm also identifying where a possible change of character might occur. This is a critical area where the market could indicate a reversal or change in sentiment. Once the change of character is confirmed, the next step is to draw the Fibonacci retracement tool to identify potential levels for trades, aligning with the new market structure. By following this method, we ensure a structured and disciplined approach to identifying high probability setups while waiting for confirmation of the trend shift. In the next step, after the change of character confirms a possible shift from a downtrend to an uptrend, I'll use the Fibonacci retracement tool and draw it directly on the chart. This step is essential for identifying key levels to plan potential entries and exits. It's important to note that the retracement drawing needs to be adjusted as the chart evolves. After the change of character, the price continues to move and creates a higher high, requiring us to recalibrate the retracement tool to reflect the new price structure. This adjustment ensures the retracement levels remain accurate and aligned with the latest market movement, helping us identify the most relevant zones for trade opportunities. By keeping the retracement updated, we maintain precision and adaptability, two essential elements for navigating changing market conditions effectively. Now, let's follow the strategy rules to execute Fibonacci retracement trades with precision. The key is to wait patiently for the price to close below the 61.8% retracement level. Once that happens, we look for the next candle to close above this level. When it does, that's our signal to open a buy position. To determine the target, we'll use the Fibonacci extension tool. Drawing, it's simple. Connect the low to the high of the move and place the third point at the retracement level. This will reveal key extension levels, helping us identify the ideal target zones. For this strategy, the stop loss will be set at the 100% retracement level, providing a clear point for risk management. And the target will be the 100% level of the Fibonacci extension, offering a precise goal for the trade. As shown on the chart, this setup results in a winning trade with a risk-to-reward ratio of 1.83 to 1, making it an excellent opportunity. By following these steps and maintaining discipline, we ensure each trade is based on a solid structure and logic, maximizing the potential for consistent and profitable results. This trade highlights the power of combining Fibonacci tools with precise market structure analysis, giving us a clear edge in the market. Now, with the market clearly signaling a shift in direction, it's crucial to adjust our approach to align with the newly established bullish trend. Following the change of character and break of structure, which confirm a transition in market structure from bearish to bullish, our focus now shifts to identifying fresh buying opportunities. The first step in adapting to this change is to remove the previous bearish structure markings, such as LH and LL, as they are no longer relevant in the current context. Next, we'll redraw the market structure to reflect the new bullish trend by marking the highs, lows, higher highs, HH, and higher lows, HL. This update is essential for maintaining a clear and accurate understanding of the market's current direction, making it easier to identify potential setups and align with the trend. By updating the chart in this way, we ensure clarity and precision, allowing us to stay aligned with the bullish market and confidently look for the next high-probability trade opportunities. We then adjust the positioning of the Fibonacci retracement tool, starting it from the most recent higher low, HL, and continuing to update the high point as the price evolves. As observed, the price once again closes below the 61.8% retracement level and then closes above it on the next candle, signaling another opportunity to enter a buy position. Now, an important point to note. After entering the trade, the price creates a lower low compared to the previous one. Although it doesn't hit our stop loss, which remains at the 100% retracement level, this requires us to adjust the Fibonacci extension. As a result, our target also needs to be updated, bringing the risk-to-reward ratio down from 1.9 to 1 to 1.72 to 1. Despite this adjustment, it still represents an excellent risk-to-reward trade. And just like before, this setup results in another winning trade, reinforcing the effectiveness of this strategy when executed with discipline and precision. In conclusion, mastering this strategy that combines market structure analysis with Fibonacci tools can significantly enhance your trading approach. By identifying change of character and break of structure, drawing Fibonacci retracement and Fibonacci extension levels, and adhering to a disciplined risk-to-reward ratio, you'll have a clear framework for making consistent, high-probability trades. This method isn't just about improving your results. It's about simplifying your decision-making process and staying aligned with the market's momentum. By following these steps with precision and discipline, you can build a trading plan that supports long-term profitability. And that's why understanding market structure is absolutely essential for every trader. It's the foundation upon which all technical analysis, including Fibonacci tools, truly makes sense. So to help you strengthen that base, we'll now play a short clip from our dedicated lesson on this core concept. Let's get started with market structure. The driving forces behind price movement can be simplified into two essential dynamics that constantly shape the market. The first is trending, which includes both uptrends and downtrends. And the second is the consolidation phase, which you might recognize as a ranging or choppy market. Think of it as a continuous cycle, where price flows naturally between downtrends, uptrends, and consolidation periods. These consolidations act as areas of liquidity building and order accumulation by institutional players. In most cases, Price needs to pause and consolidate before transitioning from an uptrend to a downtrend, or vice versa, forming the rhythm that defines every market movement. The very first question to ask when you open your charts is simple yet powerful. Is the market trending upward, trending downward, or moving sideways in a consolidation phase? To build a solid foundation, we'll start with a basic introduction to market structures. Then move gradually into the key elements of advanced structure analysis that every trader should master. Please also remember that our mission here on the ComLucro channel is to give traders the clarity and confidence they need to make smarter decisions in the market. Every video, every course, and every piece of content we create has one clear purpose: to deliver practical, easy-to-apply knowledge that helps you grow step by step as a trader. Here on the channel, you'll find complete courses on smart money concepts, technical analysis for day traders, and trading psychology, because trading isn't just about charts, it's also about mindset, discipline, and risk management. We also share lessons and insights from some of the most respected names in trading, professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, Larry Williams, and many others whose experience has shaped the way we understand the markets today. If you enjoyed this video and found it helpful, please give it a like. It really helps more traders discover our content. And don't forget to subscribe and turn on notifications so you never miss our latest insights and strategies. If you'd like to go even deeper and access exclusive content, early video releases, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support our work and a smart investment in your own growth as a trader. Thanks for watching, and I'll see you in the next video.